Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with Martin North. How are you, Martin?
Yeah, pretty good, thank you. It's been a very, very busy month, a lot of data, a lot of significant changes, so a lot to talk about.
Yeah, the Jackson Hole stuff, the Fed, a lot of jawboning and whatnot, which we've come to expect, and some, I guess, conflicting data in different countries as well, which we'll dive into. But anything overall from you before we dive into the slides?
Well, I think that the takeaway has to be that rates are going higher quicker and will stay there for longer than even I was thinking a month ago. And, like it or not, this new environment is very different from what people thought just 6 months ago, including, of course, the RBA. And this is going to have significant impacts on many people, businesses and households. And I don't believe that those with accountability are taking accountability for the misdirection that they had earlier and what they're doing now. But no surprise there, perhaps.
Interesting. I might question that line of thinking when we get to those slides about your higher for longer assumptions, but
Yeah.
let's dive into them. So you recently did a video about the jawboning and Jackson Hole. It's something that we'd love to talk about, but I think it's almost their new tool, or some of the stuff that they've come out and said about we weren't happy that we saw the markets reacting this way. And when I think they had their first mentioning of economy softening and people starting to talk about the pivot, and then they've almost come back and tried to be even more aggressive. We're going higher for longer. We're set on this course and almost happy. They want to see the markets cooling off. They weren't happy when they saw the markets rallying. So they're clearly watching the markets.
Yeah, it's a really interesting question. To what extent are they just talking rather than doing things? That means, we'll know in September when the Fed makes its next call. But it's very interesting that in the Jackson Hole Love-In, where they had central bankers from around the world there and lots of hangers-on, to a person, they were saying rates are going higher. Inflation is our main concern. We have to deal with inflation. Even if we break the economy, even if we create a recession, even if it's going to put more pressure on households and businesses, our key objective is now dealing with inflation, which is interesting because, of course, inflation was fundamentally created by their very loose lending and interest rate settings, and of course the fiscal stimulus around the world in response to COVID and in response to 2007-8 global financial crisis. So they've created the problem. And now they're saying we've got to solve the problem they've created. How good is that? But then the big question is, it's a big jawbone. How much of it will they really follow through on? And that's the big unknown question.
Yeah, and you've got that chart there that shows when Jackson Hole was, and as we just mentioned, the markets had been rallying fairly sharply, and they've come back a bit since.
Yeah, so this is the Nasdaq, and the markets have come back. Is it a bear rally? Not sure, but it's interesting that even today, with the more information coming out from the US, as we'll get on the second, markets have come down again. So I think we're going to see markets react to tighter economic conditions, higher interest rates, and very importantly, forward news on the performance of stocks over the next year or two in terms of revenue and profit. And what's happening is that at the moment, a lot of the economists and analysts are reconsidering the forward projections in terms of future growth prospects for a lot of corporates, particularly those with high debt, for example, a lot of techs, which is why the tech sector is down quite a lot, but more broadly too. And it's interesting that currently the forward view of future earnings from a lot of businesses around the world is down, and significantly down. And that's quite significant from where it was last year because, of course, last year they had significantly positive earnings results. If, in fact, those negative sentiments continue, then stocks are way overvalued, and we have to expect markets to correct another 20 to 30%. Question is that the full story? We won't know for a little while.
So next up, you've got some of the GDP measures.
Yeah, so this is the US, and it's interesting. There's two measures. One is GDP, and the other is something called GDI, Gross Domestic Income. Now, GDI is hardly ever spoken about, but actually it's half of the metrics that this committee in the US used to determine whether or not the US economy is in a recession, right? Now, GDP, well, it's a bit negative. So you could actually argue that that might lead to conclusion we're in a recession. But GDI, which is the measure of the economic activity is actually quite strong. And so if you put the two together, the net conclusion from this committee is that, well, there's no recession in the US yet. So the concept of the Fed pivoting because we're actually already in recession goes off the agenda if this is true. And that's the theme, I think. Quite a lot of strong economic news coming out of the US says it's unlikely that the US is really in recession at the moment, on the official measures at least.
Yeah, we'll dive a little bit deeper into that now. Some of the specifics that are causing that, soft spending, sorry.
Yeah, so look at the spending. So this is interesting. So consumer spending was a bit subdued in July, and the inflation sort of story was down because the cost of gasoline was down. That's because, of course, it was high and then it's come back. Now, that's enough to put a little bit of a floor in terms of the overall inflation number. So maybe inflation will come off a little bit. But consumer spending is a little bit subdued. How does that get translated? A lot of consumer stocks, some of the big retail entities are seeing demand coming off. So that's an interesting sort of phenomenon in terms of trying to work out whether the US is or isn't in a recession. And let me just say, the reason why we focus on the US is because it's by far the most significant influence on what happens here in Australia. Right? So understanding how the US dynamic is playing out is critical to be able to then make some read across to what's happening locally.
Yeah. US consumer confidence had a bit of a jump. And other thing I just wanted to mention is they've been spending heavily on credit card debt as well, haven't they?
Yeah, so consumers are still pumping the debt and still spending. And the latest, which came out from the conference board overnight, showed that, in fact, sentiment was up. And up not just on one dimension, but a couple of dimensions. So inflation a little bit more controlled, intention to spend big, including on overseas travel, up. So it doesn't look to me as though the read here is, again, underscoring we're already in recession in the US, right? The metrics look quite strong. And when you look at that in the context of the next slide, which is the job opening, so this is effectively how many jobs are out there. There's now 2 open jobs for every person looking for work in the US. So if you take consumer confidence, which is up a little bit, the job openings, which is stronger, inflation coming back because of the oil coming off, the conditions don't look recessionary yet, which turns it on its head to say, well, then does that mean that the Fed is going to have to lift rates more quickly and for longer? And in fact, now the markets are saying, well, maybe they'll go by 75 basis points in their September meeting, which will be another really big move up. And they're now talking about terminal rates of 3.5%, maybe 4%, which is significant from where they were. So I guess the takeout from all of this is that the incoming data, and they said they're going to be data dependent, right? And they keep reiterating that. The data is not saying they've done enough yet. That's the point.
Yeah. You've got the 2-year and the 10-year bond above 3%.
Yeah. So the other interesting observation is that the 10-year, 2-year bonds are still inverted. So in other words, 2-year rates are higher than 10-year. Now, that's unusual. Normally, the longer you go out, the more you expect to be remunerated for going out that long, but that's not true. And a lot of people would say, well, this inversion signals a recession coming. And in fact, after Jackson Hole, markets, the 2 and the 10 both moved up, but actually the 10 and the 2 behaved a little differently. It's the 2 that went really strong, and in fact went up pretty much as high as it was some months ago. And so that says that the expectation is that rates are going to go up, but then they are expected to come down again later. The question is when? How long will it be before effectively the Fed has to turn turtle and start reducing rates again? Will they react to the financial conditions that are created in the financial markets, lack of liquidity, all of those things which are happening at the moment? Or will they doggedly go on chasing this inflation goal and getting inflation down to 2%? And interestingly, one of the things that Jackson Hole raised was the debate about, is the 2% target the right target? Or should they have a higher target so they don't have to sort of throttle back the economy so much? Very interesting. But, it's worth saying Jerome Powell, channeling Volcker, said, no, inflation is the thing we have to crush. And it's interesting how the market's now reacting. Recession coming, they're saying.
Yeah, I guess the other side of that is with how aggressively they've gone, even though everything economic data coming out still looking good and okay, how badly is that going to crush the economy with all these levels of debt? No, I still think they're probably going to make a bigger mess, even with what they've done already than
Oh,
what
I
they're
think,
anticipating.
and the key point, there's always lag, right? The data is lagged. It's somewhere between 1 and 3 months lagged. So you don't actually see what's currently going on. You see what was happening three or 4 months ago, right? And that's really the problem. So they're going to be pulling these levers and trying to lift interest rates without necessarily knowing whether it's actually working or not. And the risk of overshoot, I think, is quite significant. And then do they then turn around again? Now, of course, they've got a history of this. They did it 2 or 3 years ago. They started trying to do a bit of tightening, and then they had to turn around and sort of rescue the financial markets again. And there are still people out there who are saying, no, this is temporary. We are going to see the markets effectively assert themselves to the point where the Fed's got to turn around. At the moment, there's no sign of that from what the Fed is saying. And of course, even people from the ECB who were there were saying, no, we have to actually hold our line here because otherwise no one will ever trust us. Better late than never, some would say. But the fact is that pretty much everybody is saying rates are going higher. How long and what happens then is the big question.
Yeah, and that's why I think jawboning is becoming a focus of theirs as a powerful tool, because I don't think they really want to aggressively raise rates. And they know that by almost talking, it's a bit like the bond market predicting things and being such a powerful force. If they can really get that sentiment out there that we mean business, we're serious, we're going to do it, while they're probably watching some more real-time data and going, wow, things are rolling over. But as long as we keep talking like this, it's going to change the consumer spending habits and business outcomes. And that's why I think they're kind of using watch what they do, not what they say.
Yeah, well, this is why I used jawboning in the first slide, right? There's a lot of waffle going on there. Let's see the beef. The other point to make is, of course, they're doing quantitative tightening. So the 9 trillion balance sheet of the Fed will start to tail down. And that's another, if you like, deflationary factor to put into this, because if they do that too, then it's going to create more liquidity pressures within the financial markets and may well then force them to be able to go a different way. So I think it's still generally open, but the markets woke up over the weekend to the prospect of more stock falls ahead, certainly in the relatively short term.
Yeah. All right. So German inflation continues to trend up.
Yeah. So this came out overnight. Inflation in Germany is 8.8% now, which is very high. Remember, they've got this 2% target as well. And it was driven very much by one thing, and that is gas and the price of energy. Obviously, that's connected with Ukraine and all the situation there. And interestingly, if you look at the price of gas on the next slide, it's actually come back a little bit. But this long-term trend, which is a futures natural gas chart, shows that if you go back last year, it was around 50. Now it's at 250, but it was actually at 340 a few days ago. The reason it's come back is because Germany's been successful in effectively storing gas ahead of the winter need. And they're actually ahead of plan. They were hoping to be at this level by the end of next month, but they're actually already there. So they've started to build a little bit of robustness. And so the argument is, well, maybe this will actually help inflation to come down just a little, although we'll see. There's lots of other factors, of course, driving it too. But the energy story in Europe is probably the critical thing. But again, the ECB, who meets later on early September, looking to probably raise rates again on either 50 or 75 basis points is probably what they're going to do.
Yeah, next up, you've got some bill shocks from the UK as well. It's crazy how much, is this going to happen in Australia? This is pretty scary.
Well, you've raised a very important point. We'll cover Australia in a second, but let me just talk about the UK. This is horrendous. This is the real impact on households of the rise in energy costs. Now, the UK is sort of partly sustained by its own gas from the North Sea, but it is still exposed to the international price of gas because effectively it's one global market and everybody is trying to go off Russian gas and try and find replacements, be it LNG or whatever. So everybody is sort of chasing the markets. And again, the volumes of transactions have gone through the roof. the price of gas has gone through the roof. As a result of that, people are looking at £5,000 to £6,000 as a typical energy bill for a typical household in the UK. Businesses have no cap. Businesses have no protection. In fact, it's small businesses in the UK who are really now falling over left, right, and centre because the cost of energy is just so high. So this is now a question of how much will the UK government do in terms of supporting households and businesses. There's a new Prime Minister going to be slotted into place in the next week or two, and there's some debate about how much they're going to have, maybe £30 billion or something to try and help people. But this is unsustainable for households and businesses in the UK at these levels. Now, come back to Australia. Problem is, our gas price is also exposed to those same global forces. And our energy prices in Australia are linked to the price of gas. So we should expect to see energy prices in Australia, particularly on the east coast where there's no reservation, there is in the west but not in the east, continue to rise. And in fact, we're already seeing electricity prices rising. We're going to see more of that as we go through summer, I think. And we cannot exclude and separate ourselves because of the structure of our gas industry, which is 95% internationally owned, trade exposed through the LNG exports, which are going to China and elsewhere around the world at massively high prices. But households and businesses in Australia will be paying a lot more for energy, particularly electricity, in the months and years ahead.
We've also seen some interesting articles about the reselling of Russian gas through China. So it's all, once again, it's all well and good for the West to impose these sanctions, but it's the average person, you know, there's something on Twitter, the cafe owner that's getting $10,000 power bills and whatever. But the free market kind of always finds a way, and I thought that was interesting that a lot of it's being filtered through and whatnot there.
Well, it's interesting because gas from Russia is being sold at about $30 lower, or even more in some cases. So you can get cheaper gas if you want to take Russian gas and then repurpose it, which is what some countries are doing. So it's all, as you say, the markets find a way.
And this has happened in the past as well, history repeating with oil when we saw sanctions and whatnot, and then that black market oil's being sold at a bit of a discount and people find a way to still move it around. So that's one thing to put on these sanctions. It's another thing to keep it all happening in the real world.
Oh, absolutely right. And oil, of course, is coming down a little bit, partly because demand is off because of the fears of inflation. There's issues with China and COVID lockdowns and things. But also, it's interesting that now some of the OPEC members are saying, well, maybe we should reduce the supply of oil to keep the price high because, of course, they want the price up rather than down. So these international markets, they take no prisoners.
Yes. All right, China's debt, Martin.
Yeah, well, I'll just quickly touch on this because, we could spend a whole show on China, which we probably shouldn't do. But, China is seeing growth slowing. The property sector is easing back. It's just worth reminding everybody how leveraged China is in terms of the amount of debt in the system there. And it means they've got limited capacity to do things. Now, what they've done is to cut some interest rates. So whilst everybody else is talking about raising rates, they're cutting rates. They're trying to put more support in for some of the construction sector entities who are in difficulty. Some mortgage payers are actually on mortgage strike at the moment in China. It's a real mess. And the economy there is continuing to slow down. That's going to raise some interesting questions for Australia in terms of the future demand for our exports to China. Of course, we're very trade exposed to China. So what happens there is going to influence what happens here.
Interesting on that mortgage strike. That's probably one thing we didn't mention in the UK. There's a bit of a movement towards the power bill strike and trying to get everyone to not pay it.
Yeah, and that is interesting. So the social bottom-up welling up of concern and anger actually could lead to social disorder and demonstrations, and as you say, people going on strike and say, well, we can't pay these bills, so we're going to cancel our direct debits and just not pay and see what happens. And the old adage, if one person defaults on their mortgage or has difficulty, they'll come down on them. But if a lot of people do it, it's harder for the organisations to deal with it. So, we'll interested to see how it plays out.
Yeah. All right, so to Australia now, the interbank cash rate futures.
Yeah, so this is the latest ASX, and this is the forward view of the market, and this has really taken a step higher again. So this is an expectation of where rates are going. They're actually going for longer, for higher, right? So they're looking at, by July 23, 3.9%, and then coming down a little bit later. If you go back before Jackson Hole, the numbers were not as high and coming down more dramatically. So everybody's now, from a market perspective, saying, well, the Reserve Bank is going to follow what the Fed does. So if the Fed's going to continue to lift rates to tamp down inflation, that's what the RBA is going to do. So we have to expect that rates will go higher in Australia. And of course, the RBA meets on the first Tuesday, expects another rise. It's either going to be 50 basis points or maybe a little less or a little more. These rate hikes are really now hurting them.
Yeah. And in Australia, we haven't seen consumers hit the credit cards like we have in America yet.
No. And in fact, the latest retail figures did actually jump for the latest month. That's for July, I think. But the thing to be understanding here, these are not inflation-adjusted figures. So this is how much people are actually spending on things now. Remember, inflation is running pretty hot. So in fact, if you were to take the inflation-adjusted view, retail is nowhere near as strong as the headline. But you're right, people aren't actually spending as much as they were, and they're not using credit as much, other than buy now, pay later, which is still booming away. Although now some people are thinking, well, maybe it's the end of the buy now, pay later boom. I guess we'll see. And I guess people will argue, well, unemployment has never been lower in Australia, so everyone's got a job who wants a job, which means that they can still earn, which means they can still spend. But the forward indicators that I'm seeing suggest that retail will continue to slide back. And there are some other indicators that are also now suggesting that in Australia, things are not that well. And in fact, we could look at that. So let's, for example, look at dwelling unit approvals, which came out yesterday. They are significantly off, particularly the high-rise sector. And what's fascinating about this is that this is a lagging indicator, because what happens is people sign up to do a home loan package or take an apartment, then they have to put the application in, and then the application gets processed. So this is a result of what happened last year when we had all of the various government stimulus packages to stimulate the construction sector. That's going away now. And the forward view is these are going to continue to deteriorate in terms of future approvals, not least because, of course, a number of builders have fallen over in the last few months, big ones and small ones, because they've been in this profitless boom of activity. Materials are going up. The ability to complete is going down, and the net is, this is a negative indicator for, I think, a slowing economy ahead.
Yeah, I dived into a bit of that data. It's the apartments in some of those capitals like Brisbane that are getting absolutely smashed, isn't it?
Yeah, and it's understandable, because if you go put an apartment application, it will maybe have 20, 50, 100, 200, 300 dwelling units, right? So if you don't do that, it drops the number. So the units is always more volatile. And in fact, house approvals are still okay, but the apartment sector coming off, which of course was the dynamo for the construction sector for the last 2 or 3 years, is very significant. Another reason why we're going to see more failures in the building and construction sector ahead, in my view.
Yeah. Consumer confidence, this is, again, conflicting to what we saw in the US data.
Correct. So this is another very interesting and challenging story, right? The consumer confidence levels in Australia are way, way down. In fact, they're down close to where they were when we had COVID at its peak. And there isn't much good news in these numbers in terms of what consumers are thinking about what they're going to spend. They're going to spend less, and what's driving it. They think inflation is going to go higher. So this is a bit of a forward leading indicator of things perhaps are going to happen. And going back to my argument about one of the forward questions is about what will earnings be like over the next 12, 18 months, because that relates to prices of stocks. Well, a lot of people who declared their results in the last few weeks didn't give forward guidance on what they think the next round of earnings will be, because it's too difficult to predict, which I think is significant when this consumer confidence information is saying people are likely to spend less. So the downdraft in Australia in terms of where the economy is heading, I think is quite a lot stronger than what we're seeing currently in the US, which may put a little bit of a brake on what the RBA does. But then, on the other hand, the RBA doesn't want to get too far out of step with what the Fed is doing, because that will damage the exchange rate considerably if we get too far out. So the RBA is being now caught in this rather twilight zone between lifting rates to deal with an inflationary problem whilst not trying to damage the economy too much. They are really badly caught. Multi-years of bad policy now coming home to roost.
Yeah, and now you've got these stress trends, and the rental stress ones continuing to go almost parabolic.
Yeah, this is horrendous. So this is from my latest data, which is now updated for the latest census information, which of course was run last year and came out a few months ago. And we've never seen so many people in rental stress and mortgage stress as we see. Now, just to be clear, I define this in cash flow terms, so money in, money out, right? How many households are having to make tough decisions and dial back their spending and prioritize to be able to pay their rent and their mortgage? And the answer is we've now got a huge number of people in rental stress, never seen it so high, 52%. And the mortgage stress at 46% is higher than it's ever been. Now, that may well translate later to high levels of default, but probably not immediately. But it does show how the economic activity here will slow. Now, not everybody's caught. There are still quite a few people with a lot of savings and a lot of buffers, and as the RBA keeps trotting out every time. But a lot of people are now in some difficulty. And with rates rising and continuing to rise, just remind everybody, typically a 1% rise in interest rates translates over a 30-year mortgage to a 15% rise in monthly repayments. If the RBA is going to move the rates up to where, in fact, the markets are saying, which is close to 4%, we're at 1.85% at the moment, that's a 30% hit. Plus, of course, we have all those people on fixed rates, which are going to roll over the next few months and go from 1.99% to 4 or 5 or 6%. So significant pressures on the downside in terms of households because of what's happening in stress land.
Yeah, and I think that, tying it all together, that's kind of why we see the differences maybe between Australia and the US, because we spend so much more proportionally on our rents or our mortgage compared to the US, and I think you've got that in one of the charts coming up at least. But let's dive into the decline in the capital cities first.
So this is from Chris Joy and using CoreLogic data. And the reason I show this one is because Chris has traditionally been a bull when it comes to property values in Australia, but he's been predicting for some time considerable falls, and now he's saying we're seeing them. So we're seeing effectively Brisbane down and the Gold Coast down 2.7% from when the RBA first announced. We're seeing the 5 capital city aggregate down 4.2%. We're seeing Melbourne down 4.5%. We're seeing Sydney down 7.2%. And then if you look at those annualized losses since the RBA, Sydney's down 19%. I mean, these are already now looking quite severe moves. And in fact, these moves down are happening more quickly than we've ever seen in any previous correction cycles, which suggests to me that we're going to see further falls, and they're spreading out into Western Australia, Tasmania, and even now I saw data on Adelaide, and Adelaide is also falling over too now. So property prices are on their way down, listings are going up, and we're just entering the spring selling season, so you would expect momentum to pick up, and yet auction clearance rates are still way down. People are being a bit more cautious, and the borrowing power of households now, in other words, how much they can get from the bank, is down about 22% from where it was just 6, 7, 8 months ago. So this market is in for a correction.
Yeah, Chris has been very, very active, vocal and bearish on Twitter. I think he's a super intelligent guy as well. I'm not sure if him and John Adams are going to be friends now that he's finally bearish on property. But I'll be interested to see if when Chris starts to pivot, I think that's why he likes to be vocal, because when he will flip bullish again at some point on property, I think. But he's been a pretty accurate forecaster.
Yeah, it will be interesting to see. I mean, there are lots of unknowns here, as I've tried to explain, between what the Reserve Bank says and what it does, and all of these other economic data points. It's interesting. Central banks are saying we're being data dependent, right? So we're not going to lay a forward path. We're going to see how the data works, and then we'll react to it, which means we might get decisions unusual decisions heading in different directions quite quick without much forward signaling, which is where they weren't previously. They tended to want to signal a long way out, like last November, Phil Lowe saying rates won't rise until 2024, right? Well, they're not doing that anymore, right? What they're doing is saying, we'll be data dependent. And on that front, I just want to remind everybody, this is the sort of the last slide for today, we are hugely indebted. So if you look at the debt to GDP numbers, these are actually from the end of last year. It's even worse now from the IMF. The debt to GDP ratio in Australia is 126%. In Canada, it's 108. In the UK, it's 90. In the US, it's 80. We are so exposed from a household debt perspective that these interest rate rises, be they small or be they large, will have a huge impact on many, many households. That's why stress is already up. That's why we've got all these issues. So that's something else to bear in mind. So the RBA is sort of caught now between wanting to ape what the Fed is going to do, whilst also trying to take account of the fact that we've got a lot of debt and a lot of debt exposure here in Australia, and 60% of consumption is consumer consumption, which drives the GDP. So if they lift the rates too high, GDP will just fall through the floor. If they keep rates too low, they won't get inflation under control. And so I suppose the only question then, it comes right back to this question, well, will they then, through their review of the RBA, which was announced and will be running over the next few months, will they then come out and say, well, actually, maybe we should have a higher inflation target? Because I can see no other way out of this hole unless they change the rules of the game again, which wouldn't be the first time, would it?
One thing that I thought was very interesting I read about was I think behind the scenes you can get a feel for what's happening. And one of the big four Aussie banks, or all of them, but the one I read about was that huge bond offering they did at, I think it was at 6%.
Yep.
So, and I think that they got this message from central bankers saying, you guys need to build capital because there's a bit of a tsunami coming. And Chris Joy was one of those people, I think, that put in a bid for maybe $200 million worth of those 6% bonds through his fund. So it's crazy when you see things like that, because I know in America they did a lot of those stress testing in the banks and said everything's fine, but that was a fair few rate hikes ago. And I think they're saying, look, you guys need to shore up reserves. And what we're seeing now with the US talk about quantitative tightening is that it's hitting all these other economies that are dependent on US dollars a lot harder. And that's why I think we're going to see that they're almost forced to do something to help what's going on outside the US, even if they want to tread their own path.
Well, it's interesting because, of course, the term funding facility, was that really cheap money that the RBA gave to the banks to lend out, is going to have to be repaid at some point. And at the moment, the banks are actually earning interest on that money because it's all parked at the RBA, and the RBA is paying money back to the banks. Aren't we nice? Our taxpayer money giving money to the banks to help with their profits. But ahead, they're going to have to repay that term funding facility. And if they're having to issue bonds at 5-6%, that's going to put a huge pressure on the financial structure of most of the banks. In fact, the banks who declared recently their earnings actually pretty much universally said their margins are being compressed. They're trying to sort of compete with mortgage lending. They're trying to lift the interest rates on some deposits. In fact, you can get a 3% term deposit if you look hard, which is an amazing change from where we were. But the net margins on banks is under significant pressure. If we start then seeing defaults raise as well, and all the issues around there, our financial system could come under huge pressure. And then the question is, at that point, what does the RBA do? And that is really the hanging question for this month, right? At what point will central banks have to change direction? Because the collateral damage to the financial system from what they're currently doing becomes so great, and the risks get so high, particularly in terms of liquidity. When do they turn? And that's the key question to try and get some forward view on, because what happens and when it happens will ultimately determine the fate of the markets, the property market, household balance sheets and business balance sheets. So this becomes, for me, the critical question now.
Yeah. All right. Great chat again, Martin. I'll see you next month. Hope everyone at home has enjoyed that, guys. And yeah, we'll talk to you next month, Martin. Thank you.
See ya. Bye.
See you guys.